Okay, welcome everybody to this week's lecture on advanced accounting. I would encourage you to watch these lectures before you get going on the homework. It's important that you have a clear understanding of this particular um, part of the class because you will be working you'll be working on this if you choose to go on and take the CPA exam, and also it'll be beneficial to you as you become if you choose to go into public accounting. Also, just as a business person, I feel like some of the things that they talk about are um, are really good for knowledge as you advance up the ladder in business and you're making business decisions. So I hope you get a lot out of this class. So welcome you to this part. So what we're going to do is talk about business combinations tonight. We're going to go in and actually do a journal entry for the business combination, and we're going to talk about how we recorded at fair value. So those are going to be the main things we're going to be working on in chapter one. We'll also have other chapters too, but this video is just for chapter one. So the first thing I want to review with you is the types of business integration. So you my actually have a family member that works in antitrust litigation, um, and one of the things that we talk about is just the different types of integration. Uh, as you go on and do business combinations and work with attorneys, these things will come up a lot. So you can't necessarily have a monopoly on something if you're very successful in an area. Um, and there's a lot of companies out there that continue to buy up other small companies, and they get into trouble with being too large or antitrust matters. Particularly in technology, there was a lot that went on in that. And there's a little bit of controversy as to how much these companies, particularly the tech companies like Google and Facebook, should have control over decisions that are made on a global scale. So horizontal integration is when you take across the same business lines and markets. So for example, let's say you make Jif peanut butter and you decide you want to buy Skippy. That would be a horizontal integration. Vertical integration is different. You basically buy up the supply chain, and I would say up until the 1990s, 2000s, that was pretty much, people would go in and buy it from tip to toe. So I know, for example, like when I lived in Arkansas, one of the chicken manufacturing plants would go in and buy farmland and, bring in, the full supply chain. Now, a lot of times, the supply chain is offloaded through outsourcing, so you probably don't see as much for vertical integration. Amazon is a great example of vertical integration, taking over the entire delivery process. Um, and then, of course, a conglomeration. So, conglomeration basically has unrelated products and has diverse products or services. And the one that comes to mind for me is Johnson and Johnson. They seem to own everything. You have, different baby products. You've got different types of products. So, you go to the aisle in the supermarket, and you can see all the different things that that particular company owns and has its hands in the pot. So, so the reasoning for combinations, and this is something that I think a lot of times, you'd be surprised some of the reasons. They give some extra ones in the book. For cost advantage, a lot of that is just to go out and get the opportunity to buy a facility at a cheaper price. So I'm using today's example. You all know what's going on with COVID-19, and everybody is very quick right now to delivering the masks and ventilators. And they're trying to get those produced as quickly as possible. So rather than open up a ventilator shop, a lot of companies are stepping in and taking over facilities to get this done, collaborating. So if you have a product and you want to, and the manufacturing process is similar, it may be less expensive rather than to open up a brand new manufacturing plant, just to go out and by someone who's got the technology and the delivery advantage. The other thing about doing a business combination is the lower risk. And what that basically means is if you pick let's say you go out, let's say you're Johnson and Johnson or um, excuse me, I don't want to use Walmart as an example because Walmart doesn't own anything per se. But let's say you want to go out and get involved. And the thing that I think about is Google and YouTube. Um, um, and some of the different places, if they want to go and reach into a technology market, if they go with something that's already proven, then they lose that R&D cost because R&D cost, research and development, is expensive. So if you wait for a tech company to come and bring it up for you and bring in the new technology, then you don't have the risk of creating a technology that's going to fail. So by buying an established business, you lower the risk. The other one, fewer operating delays. So this would be mainly this goes down to government regulation. So if you buy a shop that's already established, then you don't have to wait to go through all the approval with the government. So um, that kind of speeds up the market. So a lot of times if you have a new technology or a new idea, your goal is to get it out to market as fast as possible before someone else gets it out to market. So that's where your fewer operating delays would come in, is just not having to worry about that government interference. Avoidance of takeovers. So this one, I think we've all seen the movie Wall Street, right? I'm trying to think of another one. I think they had one in uh, where they had this example. I think this is Richard Gere in Pretty Woman, where he would go in and basically buy up heavily asseted plants. Places where the real estate is more expensive than what the product they're offering is, or the value of the assets is more valuable than the product. So a lot of times if you are a business owner and you run in, you do an initial public offering of stock, and then you turn around, you've got all your stock out there, and what happens is you can have a corporate raider come in and basically kind of low key steal it through buying up stock out from underneath you. So that would be avoidance of takeovers. So you may want to just go ahead and combine with somebody that's stronger that can keep you grounded while you are trying to fight getting taken over. Intangible assets. So when you want to buy up a new company, to buy their knowledge and technology, very knowledge based. So you might want to buy their knowledge. So that would be acquiring an intangible asset. And then the last one, is going to be tax advantage. So believe it or not, companies sometimes merge just to save on tax reasons. So, for example, if one particular company has a carry forward, a tax loss, and the other one has a tax gain, and they decide that they want to merge together so that they can, you can't see my hands, so that they can actually kind of share in that. I think from the book, and I'll read this from the book, they talked about a steel company, and one had an overfunded pension plan. So when you think of an overfunded pension plan, that means that everybody is paid into it, the pension, but nobody's been taking out. So for that reason, that became a huge kind of attractive company, because the other company had an underfunded pension liability. Maybe they had some older employees and they had not funded it, and now everyone was reaching into it. So the two companies went ahead and merged together. And I think if you're looking for that, that's on, I'm looking at the book right now. Let's see if I can do this without touching it. It's under Learning Objective 1-1 if you want to look at that story a little further. Okay, so let's look at the next thing here. Um, I think I talked earlier about antitrust. They Antitrust is a very far-reaching piece. I know we're in a global economy, and a lot of people don't think this, that this applies globally, but it does. So, one of the things is and I think the book used an example of Staples and Office Depot wanting to merge, and what ended up happening is they they ended up I don't think the merger went through because they didn't want the two companies to be able to merge. And then what happens is when you have a large company with no competition, that company is able to basically just corner the market and charge what they want. So if you have two office supplies, they're the two big dogs on the market, and they merge, then because of just their ability to deliver product, they can ramp up the prices. They ended up, I think Office Depot took in Office Max, which was hurting in 2013. So I don't know that that was the best buy for them, honestly. If it had been me, I would have scaled back. Like I'm not a fan of being too large. So who decides whether or not you can merger, acquire, or consolidate? There's a lot of people that are involved in the decision making. You can't just run out and do a merger. You have to get it approved. There's a lot of regulation that's involved. You can't, and obviously there's different places. The Federal Reserve Board, they basically check out the banks. The Department of Transportation goes through any company that might be under their jurisdiction, transportation companies. Same thing with Department of Energy and FCC. So all of these different places regulate whether or not the places can merge. Very interesting thing. The goal of antitrust regulation is to not reduce the competitive environment for customers. So just make sure you know that so that you'll have that for next week's quiz. Yay. You don't want to reduce the competitive environment for your clients or for your customers. Okay, so here's the next thing that we're going to talk about is legal forms of combination. So a lot of business combinations is kind of like a far-reaching term. It kind of covers everything. There's actually different types of business combinations. So there's the merger. The merger is when one corporation takes over all the other corporations' operations, and then that particular entity is kind of dissolved and goes away. So I'm trying to think of one, a great one, walking back to that Office Depot, Office Max. Do you see any Office Maxes out there? No, you don't. It's Office Depot. So that would be kind of a good example of a merger. I'm just using this off the top of my head. And then a consolidation is different than a merger. So basically with a merger, one person takes over and then the place that gets taken over, everything disappears. And just becomes part of the new thing. I remember I worked at a bank in the 90s that got bought 5 times, and each time we got a new pen set, and we got new business cards, we got new this and new that, and everything else got thrown away in the trash. I kept some of them around though, just for fun. So, all right. So consolidation is when a corporation takes over the assets of 2 or more business entities and then dissolves them. So it's a brand new corporation, that not just one taking over another. It's somebody completely outside taking over 2 different or more places, and then those places dissolve. So you could look at it numerically and say, okay, 1 to 1, and the first one goes away for merger, and then 1 to 2, and those 2 go away for consolidation. Okay, so here we go. A plus B equals A. There's your merger. Oh, wow, I'm ahead of myself. Yes. One thing I want to talk about, and they don't talk about this in the book, and when I read the book the first time, I just was like, wow, this just feels like a glaring, like something that we should know, but maybe we're not talking about as much, or maybe it's just not shouted out the way I'd like to be shouted out. When you buy another company, you usually issue some of your own stock. to the shareholders. So I was actually involved in a business combination where, again, one bank bought another, and we had the opportunity to buy that bank stock. It was Bank of America. Super awesome deal. We all made a bunch of money off of it, for those of us who got bought. But what happens is the corporation issues the stock of themselves, like Office Depot issues its own stock to the new shareholders, and that's the compensation that's usually given to buy a new company. So you can't go buy another company if your stock is in the toilet, because nobody's going to want it. So when you do the journal entry, just in the back of your mind, think to yourself, okay, credit common stock because I'm issuing common stock. And when I issue common stock, if I go back to my beginning accounting days, it's a credit to common stock. Okay. So just kind of like float that around in your mind. By the way, just very quickly, I am wearing a headband because I broke my glasses. I don't know if you can see over here. And because of the circumstances involving COVID-19, my optometrist is not open right now, so I'm working on it. I ordered a glasses repair kit on Amazon, so we'll see next week. Maybe I won't be wearing a headband. All right, so that's mergers. All right, common consolidations. All right, company D acquires E and F, so two companies bought by one big one, and E and F go away. Company D survives. And basically takes everything from E and F, and their names go away. They're dissolved. Um, so they talk about bank consolidations. Yeah, and I was around in '93 when all of this happened. So yeah, I totally get that. Okay, so it's really important for the quiz and for everything else that you get the terms straight between mergers, uh, mergers and consolidations. Make sure you know those. Um, and then let me skip past this here. Okay, so a business combination. Okay, so sometimes you don't have a merger and consolidation. You have what's called a business combination. And what that might mean is a parent firm um, purchases less than 100% or purchases an interest in another firm. So they're not 100% owner. They may have a controlling interest, but they don't own all of the stock. So if the things we were talking about earlier, and I want to bring this point forward with mergers, is those particular consolidation and merger, 100% control, 100% of the stock, everything goes away from the previous, right? Here in a business combination, it's less than 100%, and the firm gets to keep its name when you acquire it. So for example, let's say you were, I'm thinking of the name and it's getting away from me. It's the virtual reality firm, Oculus. There it goes. There it goes. All right. So let's say, and I'm straining because I don't remember the full terms of Facebook, but let's say Facebook wants to take a controlling interest, but they want to let Oculus have some control over like the technology and the management and the day-to-day. So they might acquire a portion of it, or maybe they just want to acquire a portion of it for speculation, like they think this thing is going to blow up, right? So that would be a business combination, and it's really good um, with business combinations. There's a few things that you should know, um, and these are just from your book. Um, when separate businesses are brought together in one entity, okay, and their resources come under a single management team, um, then they might become subsidiaries. They might transfer some of the net assets, and sometimes they might transfer some of the net assets to a newly formed corporation. So, and this is all in your book. All right, so after 2008, um, you have to use the acquisition method for all business combinations. And here I have marked in my book, um, it follows the same gap for recording a business combination as we would do if we were recording the purchase of assets and liabilities, and incurring the assets and liabilities. So the way I like to think about this, and you may not remember this from an intermediate accounting, is when you used to do those exchanges, and you would you would purchase a truck, and then you would, maybe do from one other business. When you used to do those business exchanges, it's the same concept, only this time they're exchanging common stock. So whenever you used to have to take the old equity, the old expense off the, let's say, I'm not explaining this right. Let me just back up. Let's say you had to take off the old depreciation, revalue it at fair market value, and all those sorts of things. It's the same concept. The main thing that you have to understand is that when you acquire the business, the new business, you're acquiring that at fair market value. You're not doing it at the value that they have on their books. So when they sell it, so what we're going to be doing in this class for most of the time is trying to reach out for that fair market value and get it recorded on the purchasing business books, and then the business that's being purchased or the subsidiaries books. That's pretty much what this whole class is about. And you think it would be really easy, and it really so is not. I'm going to just leave pooling of interest off. They bring it up in every book. Pooling of interest has not been around since the mid 90s, so I don't want to go into it. Okay, never mind. Let me just hear. There we go. There we go. Okay, here we go. If equity securities are issued by the acquirer. So that basically means that the person that's buying the business, all right, issues stock. Remember we said earlier they issue stock to buy the business? Charge, registration, and issue costs. Okay, so all those fees that you have with issuing go against the fair market value of the securities issued as a reduction of paid in capital. So remember that, because that's where you're going to adjust the paid capital. All those fees that come in, that actually goes against the additional paid in capital. And then other direct combinations are charged to expense. So the legal fees and finder fees and indirect combination costs go to expense. So you need to make sure you know the difference between charge, registration, and issue costs, and then combination costs like legal fees when you're going through and working your problems, because that'll make a difference. Okay, so when acquiring firm transfers its assets, other cash as part of the combination, any gain or loss on the disposals is put into current income. Okay, so when basically, and for the most part, I would say it's probably going to be stock, but if they use their if they used something else to pay for it, then you would look at the gain or the loss on the disposal. So one of the things that you're going to run into later on is called a bargain purchase. And that basically means that the assets that the company has are worth more than what you paid for it in equity securities. So the assets were, and I think we kind of talked about that earlier in this lecture, the assets are actually worth more. Then there's a bargain. It's called a bargain purchase. You basically got a good deal on the company. And then the other thing is the goodwill. So that's the other side of it. That means that you paid more than it was worth, the fair value of the net assets. Maybe you wanted to get that brand name. Maybe you just wanted that company. And I am just spitballing here of a good example of this. And I can't remember the company, but Facebook bought, and now I'm just struggling for who they bought. And it'll come to me. Maybe I'll bring it up in the rest of the lecture. But they did a massive goodwill purchase recently, and it ended up turning out to be a pretty good deal. And I wrote it down for this lecture, and it escaped me. I'll tell you later. So, okay, so let's go in here to the stuff that you care about as you're trying to work your homework. All right, so let's talk about Pop and Son. First off, we're going to see Pop and Son a ton. Pop and Son. This is a really complicated, a lot of journal entries and a lot of mathematical arrival in this class. So you just need to kind of be patient with it. But for the most part, it's not too terribly difficult. All right, so here's the first one where they issue shares, $10 par value for Suncor's Pop stock, valued at $16 per share. So when you issue the shares, you're going to do your journal entry. You're going to do your credit at par. Oh man, this is the worst. Oh, Control C. Okay, well, I guess I can't. It's driving me nuts. You're going to do your journal entry, all right, at par value. Par value right here, okay? That's going to be your first credit. So if you're trying to figure out what to credit, that's going to be your first one right here. Always put the common stock in at par value. And then the investment in Sun Core right here, all right, this is going to be at the fair value. Stock is valued. So that's going to be the debit for the journal entry. And that's basically what you're saying is I am putting up this amount of stock at this par value to buy this company at $16 per share. Now, you think about the investment Suncor. We tend to look at investments as credit pieces, but you're actually debiting, you're getting an asset in the purchase of the company itself. You could even debit Suncor. Maybe not even put the words investment in Suncor. That's a debit. That's an asset because now you own another company, right? And then you put up your own common stock. And then the difference between those two is the additional paid in capital right here. Okay, so I would yell out any questions, but here we are on a video lecture. So take a moment to let that sink in. And then if you need to ask me a question, just hit me with the text message. That is perfectly fine too. All right, so let's walk through again another example of a journal entry. Popcorn pays $80,000 cash in finders and consulting fees to register and issue its common stock in thousands. Okay, so the first thing is if we go back 2 slides, we know that finders and consulting fees are expenses, so that's the easiest journal entry. You notice it's 80,000. We put all these in thousands. There's a couple of times where I in the homework wrote it out, and there's a couple of times where I didn't. So you're just gonna have to work with me. I had my reasons. The next thing is they also paid $40,000 to register and issue the common stock. So again, $40,000 to register and issue. And remember what, hold on, let's see if I can undo. I cannot do these straight right here, sorry. These, let me see if I can erase this. There we go. I can't stand unstraight lines. Drives me nuts. Okay, so if we register and oh man, it's harder than it looks to do this online. All right, here we go. Last chance. I'm trying to make it nice and straight by the time I get through this. All right. All right. If you register and issue stock, remember what we talked about 2 slides ago. It comes up against additional paid in capital. All right. It's not an expense. It's actually a debit against paid in capital. And then of course we paid $120,000. Right here is our cash totals. We add these together. Now, Suncor is assumed to be dissolved, so Popcore allocates the investment cost to fair value of the identifiable assets and liabilities assumed. And then the excess is goodwill. So that you can probably guess what kind of business combination this is. Does anyone want to raise their virtual hand and yell out the word merger? Because if they did, that would be the correct answer. Yes, raise your virtual hand. It is a merger. Okay, so I brought in the previous slide where we issued the shares for $10 par value, pop stock value at 16 per share, just so I could show you what we originally did. And remember how I said, oh, the investment in Sun is like you're buying Sun, paying with it for common stock, and then the additional paid in capital is the over and above the par value, the fair market value of the stock, right? So we've got this investment of Sun, but we're also getting Sun's receivables, inventories, plant assets, remember, because we're taking over, right? And then we're also going to take over Sun's debts, accounts payable and notes payable. So what we're going to do now is we're going to wash out this to get all of the stuff from Sun in favor of breaking down that 1600 and bringing in Sun's accounts. So what we do is we come in here, and these are all Sun right here, like all of Sun's receivables, Sun's inventories right here. This is all the Sun. We just bought it all, you know. We're going to go ahead and put it on our books. These are assets as debits, and then we're going to put on this, and then we're going to put on this. Then we're going to bring in the 1600 right here as a credit, right? Okay. Then we're going to add these together, the assets right here, and then the liabilities, and then the difference between these two right here is the goodwill. Right there. That's where the goodwill comes from, and that's how you do it. So basically, you do one journal entry for the investment to get it going, show this common stock right here first. This is step one, right? And then once you get the stuff, then you work on getting it on the books, and then you'll wash out the 1600 or millions, thousands, whatever, it's in thousands, okay? Okay, so we've got some good things going here. You guys are doing such a great job. I know you are. I just really love teaching this class. Just a joy, such a joy. So now we talk about identifying the net assets. So as you are purchasing Sun, you're going to come through and pick out the things that are tangible that you can find. And some of these assets are going to be intangible, so you're going to have that too. It could be a patent, the liabilities and everything. And these are the things that you would include right here: research and development and process, contractual contingencies, and some non-contractual can't say that word, contingencies. All right, and then you're going to assign fair value. So remember when we put all those assets on our books, when we started our new purchase of Sun, we put them in at the fair value, not the book value that Sun has on its books. We're putting it in at the fair value. And here are some ways to establish a fair value. A lot of people like to use the cash flow, discounted. There won't be very much discounting now. You know, the Fed just dropped the rate again. And then there is some guidance if you don't use the fair value rule. We're not going to go on to this too tightly. Again, goodwill is the excess of the investment cost over the fair value of the net assets. So that's the price you pay to buy the brand, to buy the people. I am desperately trying to remember that Facebook acquisition. It was a good one. They paid like $18 billion. It'll come to me. I might have to go back and read a paper that I wrote to remember that. I'll tell you all at some point in this lecture. All right, contingencies. They kind of talk about that. If you have so many different contingencies, cash payments, share issuances, and that sort of thing. Okay, so let's look at PAMCOR. Okay, and let's read this together. PAM acquires the net assets of Sun in a combination consummated on 12/26/2016. The assets and liabilities of Sun on this date at their book value are okay. So now let's look here at PAMCor and let's talk about what's going on here. So the first thing that I want you to understand about this example, and this took me a couple of times in the book to fully grasp, because it looks like they're giving you the PAMCor data, but if you read up here, the assets and liabilities that they're showing here, which I thought was weird, are Sun Company, not Pam, not the buyer. So PAMCor, Pam is the buyer, and I think if you're doing this, trying to write and it looks terrible, but online school, okay, and Pam is the buy, is the bot, Sun is the bot, okay, so you need to make sure you know who's buying and who's getting bought. So when you're doing your problems, stop and think about that. It'll save you hours and hours of like trying, why is this like this? Just who's getting bought, who's buying. So this is Sun. This is actually, it says PAMCor data, but this is actually Sun right here. This is all Sun's stuff. Okay, so it's Sun's stuff. So this is Sun's cash, book value, fair value. Which one do we care about? Right here. Do we care about Sun's fair book value? No, that's all going to go away. Sun is going to close their books and their stuff is never going to be around again. It's all going to become Pam. Okay, so as we look through here, you can see the difference between receivables, inventory. Looks like inventory is actually valued a little higher. Land, buildings, equipment, patents. This is interesting, the fair value of a patent. Accounts payable, notes receivable, sorry, didn't mean to be yawning. Other liabilities, and then these are the totals. Actually move this so you can see. Okay, so just make sure you understand who's the buyer and who's getting bought. Okay, so Pam pays $400,000 in cash and issues 50,000 shares of $10 par common stock with a market value of $20 per share for the net assets of Sun. Okay, so here's the consideration. The consideration is the market value. Remember, the market value times the number of shares. All right, and here again, this is where it gets a little confusing because of the zeros business. That just blows. Remember that this is in thousands, right? So here is our 50,000 right here, only it's in thousands, right? So it's 50 shares, 50 in thousand times 20. And then 400, remember in thousand, right here. Here's a cash right here. Okay, times $20. Market value. Market value. I'm saying it a lot because I don't want you to get all mixed up. This is the consideration. Is this going to be the journal entry? Not necessarily. We're just trying to figure out goodwill, right? So remember we were doing that big list. I said add these and subtract these, and the fair value of the assets minus the what you paid plus the liabilities is the goodwill. Well, here you go. You can do it the short and simple way. Subtract, and there's 200 in thousands of goodwill. Okay, so let's record it. So the first thing, remember we've done this before. If you're not sure, go back and look 3 or 4 slides and just turn off and mute. You don't have to listen to me talk or look at my face. Where's our investment? That's step 1. Remember, we're buying Sun. So we're going to go ahead and do this part first. 400 in cash. Remember that the common stock is recorded. The common stock is recorded at the par. Remember, this is the fair. Fair was I think it was about $20. This is the par, right? That was the total investment in Sun, common stock, credit. Okay. The cash, we do this next. Remember, because we gave up some money. So let's go ahead and get that in there. Cash and common stock, all of this in there. Okay. And then we know that we took the market value from the previous slide. We take the 1400. This is terrible. I'm doing this with my mouse. Maybe I'll get better. Minus 900. And that gives you the 500 right here. That's a plug figure. What happens if there's some sort of registration? That'll come off of the paid in capital. See, I bet you all can remember that. So just as we were discussing earlier, as we're making the investment in Sun, and I pulled this in from the other screen just so you could see how the debit investment comes up against the credit. And then again, we're bringing in all these items from Sun Corporation that Pam now owns at the fair market value, the net receivables. Again, when we're looking at Sun's balance sheet, we are looking at bringing it over at fair market value, not book value. Fair market value. So you'll see that list of two items come in with the fair market value amounts. And then again, we add all these up. Here's all our accounts payable. All right, and then here's our original investment. So now we're crediting it, and then that will wash off against the original, and then what Sun will completely go away, and what will be resulting is all the things that we purchased, and then the difference between that is going to be the goodwill. So it's the same concept again. Okay, so I did a little bit of writing, and I'm going to see if I can get this to come back up. Before I started this part of the slide, we're going to talk about this new thing with the bargain purchase. And the first thing that I want to bring out is the bargain purchase is when you pay for something that the assets are worth more than what you paid for it. So let's walk through this together. The first thing we're going to look at is the shares. We're going to look at the fair value. And I brought this in. You may remember, I believe this is slide 28. You may have forgotten this, but this is where we got our fair value. It's at the bottom of slide 28. Remember Sun's fair value right here. You can barely see it. That is where our 1200 starts from. So we're just going to carry this forward from the fair value. Now, what did we actually pay for it? First thing we did, we acquired 40,000 shares. Remember, this is in thousands, so let's just kind of wipe these off for the sake of math. All right, at $20, the market value right here, $20 per share. Okay, so we're going to multiply these together. It doesn't show you on the slide. This comes out to be about 800. Trying to be very nice and tight. Comes out to about 800. Add this with the note. The notes payable. The note payable that we got for 200,000. Okay, we're going to drop the zeros for the math. And that's where we have our total consideration. That's what we actually paid for it right here. What we paid for Sun, like sunshine. And this is the value right here. This is what it's worth right here. Okay, so that's how we're going to know. What happened is the assets are worth more than what we paid. So we have a bargain purchase, and that's where the gain on bargain purchase comes. Now, let me stop you right here. You're going to have to take out your pen and paper, or do it in an Excel workbook or whatever to figure these things up. You can't just look at the screen and then sort this out in your tired and exhausted, hardworking brain. Pull out a sheet and set this up, or put it on an Excel worksheet so you can figure out the gain from bargain purchase. All right, so the next thing we're going to look at is we're going to record the assets. Okay, the investment in Sun, and hopefully you've seen enough of this from me, is what you paid. Okay, now we paid with it the 1,000, that's not the fair value. Remember, the investment is always what we paid. All right. So we took on this note payable. All right. Then the common stock, hopefully, we are now very comfortable at putting in the common stock at par value. Okay. Par value right here. Okay. And then the additional paid in capital is the over and above that we paid, which was the difference, the extra from this. This will be our additional paid in capital. I'm not saying this correctly. Let me clarify that. The additional paid in capital is the plug figure after we take our note and we take our common stock off. Remember, our common stock comes off at par, and then this is our plug. Okay. All right, so now it's time to do the gain from bargain purchase. So again, we go back to Sun and we bring everything over at the fair market value. Put it on as a debit. Take Sun's debits, make them your own. On and on. Buildings at fair market, equipment at fair market, patents at fair market, accounts payable at fair market, everything at fair market. Never ever book that will mess you up if you go to the book value. Okay, note payable, same situation. Okay, other liabilities, everything's going. Okay, but here's the kicker, and I'm going to write this out over here so you can see it, because, sometimes this right here is a credit of 1,000. Try and do a really good job drawing, and it's so hard. And this right here is a credit of 200 from our gain, which we figured out on the sheet of paper. Remember from the previous slide? Okay, and these are all credits, CR, credit, debit. Okay, so these are, and I'm afraid my video is hiding it. That's why I'm trying to write it over here. Oops. Here, hold on. There. Just can't stand that. Okay, so now I've got all my liabilities right here on the credit side, and I got all my assets right here on the debit side. All right, and everything from the Sun, the gain will come in here, will be a credit. The gain will be a credit. Okay, so the gain is going to be a credit if you overpay. The goodwill is going to be a debit if you, I'm sorry, let me respeak this. The gain is going to be a credit if you got a bargain or you underpaid for what the assets are worth. And then the goodwill is going to be a debit if you paid more than what the assets are worth. I wouldn't say overpaid because, there's some worth there. So the gain is going to be if we paid more, or I'm sorry, paid less than what the assets are worth. And the goodwill is going to be a debit if we paid more than what the assets are worth. Okay, so some closing parting comments on goodwill. Goodwill is capitalized when you cannot figure out what the value is or separate. I'm sorry, not figure out what the value is. When you can't separate intangibles. If you can't separate out an intangible asset and clearly mark this off as this particular asset, like a patent is very easy to separate out. There's others that are harder to separate, and for those types of reasons, if they can't do it, then it goes into goodwill. And they have a list of identifiable types of assets that are easily separated. Marketing related would be like trademarks. Customer related would be like a customer list. You can definitely separate that out. Artistic things, musical works, contract based, royalty or licensing. That's easy to identify. Technology based would be certain patents or computer software. There's all sorts of things in there. Okay, so if it falls on, there's a list in your book. If it falls underneath that list, then it's separable and you should be able to figure out. The other thing is everybody gets together once a year and says, hey, we put this goodwill on the books. Is it still worth it? Is it still worth what it should be? And you have to kind of go in and say, has it been impaired? Maybe the company has lost face. It doesn't have its value the way it should for whatever reason. There's a lot of reasons why we could go on for, there's a whole dissertation about goodwill. You go in, you impair it. If you do a test, if you can't impair it, then it leaves alone. If not, then you have to write it down. And then you basically come in. A lot of times it's used against the cash flows. Like, for example, you go in and the step one is to compute the book value to the fair value and see if there's been a loss. And the other one is to determine the implied fair value. So if the book value starts going below the fair value, it gets very tricky in technology firms when everything is kind of out there. Book value is very hard to determine with certain intangibles. And so what the big controversy is that someone could just write off goodwill whenever they felt like it, or they needed some sort of tax write-off. And so that's the big argument about goodwill impairment, because it's kind of squishy and it's really hard to decide how to do it. And it's been like that for dozens and dozens of years. So whenever you hear about how a company is not necessarily being ethical, maybe they just take a big write-off because they already feel like they're going to have a bad year, so they just go ahead and clean out the goodwill, and then the next year they'll look better. Those are some things that happened. The other one is if they need a tax to relieve a tax burden, and then they write off a bunch of goodwill, then that's definitely going to be looked at with the auditors. So here are some things where you would test. One of them is, these are all squishy things. Adverse action by a regulator, unanticipated competition. I mean, how do you actually quantify that? So that's tricky. And then the type of disclosures you need for disclosures. And then of course Sarbanes-Oxley. I don't want to go into that too deep because there's enough Sarbanes-Oxley talk. I'm going to skip pooling interest. This is my first slide set. Hope you enjoyed it. Hope you got something out of doing the debits and credits, because that's really how your homework is set up. And hopefully you guys are going to be amazing on that. And I put enough hints in there for you to work the problems. All right, have a great night. And I'll be putting up slide set number 2. And thank you. Stay safe out there. I'm looking forward to being back together soon.